Welcome back to the Deep Dive. Today we are opening the books on something really crucial in insurance finance, reinsurance.
It sounds complicated, and honestly, it can be.
Yeah, it's basically the insurance company's own insurance.
Mm.
Vital stuff for managing risk. But, figuring out how that risk transfer actually hits the financial statements, that's where it gets genuinely tricky. So our mission today is basically to give you a shortcut. We want you to see how shifting that risk changes, well, everything. The income statement, the balance sheet, and the cash flow statement.
And the key thing is you really have to look at it from two sides. Always.
Two sides.
Yeah, you've got the ceding company that's the primary insurer paying to get rid of some risk. And then you've got the reinsurer, the one taking on that risk.
Okay.
We're going to look at how their financials basically mirror each other. It's quite an interesting balance.
Okay, let's dive in then. Let's unpack the income statement first, the P&L. How does things change right away for the ceding company, the insurer?
Well, it all starts with their total sales, right? The gross written premium, or GWP, that's all the money they collect initially.
Right, that's their top-line revenue.
Exactly. But because they're handing off some of that risk, they don't keep all that money. They have to pay a portion of it to the reinsurer.
And that payment, what's that called? That's like an immediate cost for them.
Precisely. It's called the ceded premium. And yes, it's booked straight away as an expense. It directly reduces the premium income they get to recognize. It's basically the cost of buying that protection.
Okay, so income goes down.
But it's not quite that simple. There's often a flow back the other way. The reinsurer might pay the ceding company a fee.
A fee. Why?
Well, it's sort of an acknowledgement that the first insurer, the cedent, did all the groundwork, finding the customer, issuing the policy, handling the admin. This payment back is the Ceding Commission Income.
Ah, okay. So wait, the ceding company pays out the ceded premium, that's an expense, but then gets some income back in ceding commission? Seems a bit circular.
It can feel that way, but it reflects the different parts of the transaction. The net result, what the ceding company actually earns from the premiums after all this, is called the net premium earned.
And the formula for that would be?
It's the gross premium minus that ceded premium expense, but then plus the ceding commission income they received. So yeah, the total revenue figure, the net figure, is smaller than the gross.
Right, and that's a key point. If that top line shrinks, doesn't that maybe look less impressive to someone just glancing at the numbers? Like the company is writing less business.
That's a fair question. On the surface, maybe. But the real benefit, the strategic reason for doing this, becomes obvious when there's a claim.
Okay, let's talk claims then.
So just like the premium gets shared, the claim cost gets shared too.
Yeah.
The ceding company first records the full cost of the claim, the gross claims incurred. That's a big expense line.
But they don't actually pay all of it because of the reinsurance, right? So where does the money they get back from the reinsurer show up? Is that like new income?
No, and this is crucial. It's not income. That payment back from the reinsurer is called the reinsurance recovery, and it acts directly to reduce the claims expense.
Okay. So it lowers the cost side.
Exactly. So the final expense hitting their P&L, the net claims incurred, is just the gross claim amount minus whatever they recovered from the reinsurer.
Okay, so let's recap the P&L for the cedent. They pay out ceded premium, which lowers their immediate income. But the big win is that when a claim happens, the reinsurance recovery slashes their net claim cost, making profits much smoother.
That's precisely the trade-off. You accept slightly lower revenue day-to-day for much, much greater stability and, frankly, predictability when losses occur. Less volatility.
Makes sense. Okay, let's flip the books, as you said. What does this look like for the reinsurer? Is it just the opposite?
Pretty much a mirror image, yeah. The ceded premium that the first company paid, that's the reinsurer's main revenue. They call it assumed premium.
Right, they assumed the risk and the premium.
And their main costs. Well, first, there's the commission expense. That's the ceding commission they paid out to the original insurer.
Okay.
And then, of course, the big one, the cost of the actual claims they agreed to cover. So the claims paid or the money they have to set aside as reserves for future claims payments on that business they took on.
And for them, the bottom line is the underwriting result, right? Did the premium they took in cover the claims and the commission they paid out?
Exactly. That's their core insurance profit or loss. They're essentially betting that the assumed premium will be enough to cover those claims and expenses over time.
Okay, P&L impact seems clear. But you mentioned this is also about solvency, about capacity. That sounds like we need to move to the balance sheet. This is where things get really interesting, isn't it?
Absolutely, because reinsurance fundamentally changes the company's risk profile, and that's reflected directly on the balance sheet. For the ceding company, it's mostly about strengthening their position.
How so? What shows up?
Well, the single most important asset created on the ceding company's balance sheet through this is their reinsurance recoverable.
Okay, define that for us. Reinsurance recoverable. It's an asset, you say. Why? What is it exactly?
Think of it like this. The ceding company has paid a claim to a policyholder. They know a chunk of that claim is covered by their reinsurance agreement,
Right.
but maybe they haven't actually received the cash back from the reinsurer yet. The reinsurance recoverable is basically an IOU from the reinsurer. It represents the money the reinsurer owes them for claims already paid or incurred. It's a promise of future cash inflow, so it's an asset.
Got it. An IOU from the reinsurer. Makes sense. What else changes on their balance sheet?
Just as important as adding that asset is reducing liabilities. The ceding company gets to take a large portion of its policy liabilities, its promises to pay future claims, and essentially transfer them off its books.
Oh.
These are accounted for as ceded reserves. They directly reduce the total amount of reserves the ceding company needs to hold against its policies.
Wow, okay. So reducing liabilities like that. That must be huge for their capital position, right? Their capacity to write more business.
It's the absolute engine of solvency improvement. You've got liabilities going down because of ceded reserves, and you've got assets potentially going up because of reinsurance recoverables. The net effect.
A much smaller net exposure.
Exactly. It directly improves their solvency margin, their risk-based capital ratio. It frees up capital, lets them take on more risk, write more policies. It's a core capital management tool.
That really clarifies why they do it, beyond just smoothing income. Of course, they might still owe the reinsurer the premium if they haven't paid it yet.
Correct. That would show up as a short-term liability, a payable to reinsurer, minor compared to the reserve shift, usually.
Okay. Now, the reinsurer's balance sheet must be the opposite story then. They're taking on all this stuff.
They are absorbing the risk load, yes. On their asset side, they might have a premium receivable, the premium the cedent owes them, but the big impact is on their liabilities. Their liabilities swell significantly. They have to book technical reserves for all the policy risks they just assumed.
So they take on the reserve requirement the cedent shed.
Precisely. And they'll also have liabilities like claims payable back to the cedent for covered claims and potentially commission payable if that hasn't been paid out yet. They're taking on the capital burden.
Okay, balance sheet impact understood. Let's shift one more time from the promises and the reserves on the balance sheet to the actual movement of cash, the cash flow statement.
Right. This focuses purely on the timing of money changing hands. It's all about operating cash flow here.
So for the ceding company, what are the main cash movements related to reinsurance?
Well, the big obvious outflow is the premium paid to the reinsurer. Cash goes out the door to pay for that protection.
Okay. And inflows?
The main inflows would be the commissions received back from the reinsurer and, crucially, the claims recovery from the reinsurer. This is when the reinsurer actually pays them back for a covered claim.
And the timing of that recovery is important, isn't it?
Hugely important. You see, the ceding company often has to pay the policyholder very quickly when a claim happens. But getting the reimbursement, the claims recovery cash, from the reinsurer might take, days, weeks, sometimes longer.
So there's a timing gap.
Exactly. And that gap creates a credit risk, that reinsurance recoverable asset we talked about. It's only valuable if the reinsurer actually pays up promptly, if they're slow, or worse, if they can't pay.
Then the ceding company has paid out cash but isn't getting it back when needed. The cash flow statement really highlights that operational dependency.
Absolutely. It underscores that the promise, the asset, is only as good as the reinsurer's ability and willingness to pay.
And flipping it again for the reinsurer, their cash flow.
Their main inflow is simple. The premium received from the cedent. Their major outflows are the claims paid back to the cedent when claims occur, and the commissions paid out.
So their whole cash flow model is about managing that inflow of premium against potentially large, lumpy, unpredictable claim outflows down the line.
That's the essence of their business model, yes. Balancing liquidity.
Okay, this is great context, but let's try and ground this. Let's run some numbers. Can we take that hypothetical policy example from our notes and see how the P&L actually shakes out for both sides?
Yeah, absolutely. A numerical example makes it much clearer. Let's set it up. We have a policy with a gross premium of, say, 10 crore.
Okay, 10 crore gross. And the insurer decides to cede 40% of the risk.
Right. So the ceded premium expense for them is 40% of 10 crore, which is 4 crore.
4 crore expense. And let's say they get a ceding commission of 20% on that ceded premium. So 20% of 4 crore, that's 0.8 crore income for them.
Perfect. Now, let's simulate a loss, a big one. A 5 crore claim happens on this policy.
Okay, 5 crore total claim. But since they ceded 40%.
The reinsurer is on the hook for 40% of that 5 crore claim. So the reinsurance recovery is 2 crore.
Got it. Okay, let's calculate the ceding company's profit impact first. What's their net premium earned?
It was gross premium, 10, minus ceded premium, 4, plus ceding commission, 0.8. So that's 6.8 crore net premium.
Okay, 6.8 crore earned. Now the claim cost, the gross claim was 5 crore. But they get 2 crore back as a recovery.
So their net claim expense is just 5 minus 2, which equals 3.0 crore.
Right. So their net result, 6.8 crore in net premium minus 3.0 crore in net claims. That's a 3.8 crore profit for the ceding company.
Exactly. On a policy that had a significant 5 crore loss, they still made a 3.8 crore profit because they transferred 40% of that hit. Huge difference in volatility.
Okay, now the reinsurer's side, what was their income?
They received the assumed premium, which was the 4.0 crore the cedent paid them.
And their expenses?
They had two main expenses here. The commission they paid out, 0.8 crore, and their share of the claim they paid, 2.0 crore. So total expenses are 0.8 plus 2.0, 2.8 crore.
Right. So their income was 4.8 crore, expenses were 2.8 crore, leaves the reinsurer with a 1.2 crore profit.
Correct. In this scenario, both made a profit. The key point is how much smoother the ride was for the ceding company thanks to the risk transfer.
Yeah, that numerical example really drives home the stability argument. Okay, that brings us towards the end. Let's maybe just quickly summarize the absolute key things you, the listener, should take away from this.
I think, for me, one of the most maybe counterintuitive points is how using reinsurance makes the P&L, the income statement, look a bit, well, smaller in the short term.
Right, because that ceded premium is an expense. It reduces the revenue you report right away.
Exactly. But the real power, the strategic upside, is all on the balance sheet.
Yeah, you keep coming back to that. The reinsurance recoverable as that key asset, that IOU from the reinsurer, and the ceded reserves actively shrinking the liability side.
That's where the strength comes from. It's less about the immediate profit number and more about financial resilience.
And why does that resilience matter so much?
Because it directly impacts the company's solvency margin, its capital adequacy. It determines how much risk they can safely take on, how stable they are. It's fundamental to trust and growth in insurance.
So we've kind of established this tension, haven't we? Reinsurance deliberately lowers the reported income on the P&L. You sacrifice some top-line revenue.
It's a calculated move.
But in return, you get a much stronger balance sheet, lower liabilities, less risk exposure.
Yeah.
Which leads to, I guess, a final thought for you listening. When you're looking at an insurer's results, how do you weigh those two things?
Yeah, that's the question.
How much importance do you give to that short-term P&L income versus the long-term balance sheet strength and solvency that comes from maybe aggressively transferring risk? What's the real measure of sustainable health for an insurer? Something to think about next time you look at their financials.